I don't know whether everybody heard what Jamie Dimon said the other day. He upgraded his forecast or his feelings about what the global economy, or particularly the American economy, but also the global economy, offered in terms of prospects from storm force to hurricane. This is only in 9 days. 9 days he went from storm force to hurricane. What most people missed was actually what he then said, and this was at a banking conference in New York, and that was that JP Morgan Chase would take appropriate action to control the risks from this increasing economic uncertainty. Now, he all but said that JP Morgan Chase will stop expanding bank credit, and it will probably start contracting bank credit where it possibly can. Now, this is very important because he is the leading global banker in the world. And he is listened to by colleagues in other global systemically important banks very closely. And if those individuals had not by then formed a similar conclusion themselves, they will have formed it after listening to what Jamie Dimon said at that conference in New York. This is extremely important. What we're saying is that 9/10 of the circulating medium, which is bank credit matched by bank deposits, which makes up the broad measure of money supply, together with the currency in the form of banknotes issued by the Fed, 9/10 of the money in circulation is going to undergo a contraction in its quantity. And in terms of mining finance and the availability of finance for mining projects, this is going to make life very difficult. So what was he actually referring to? Well, I wanted to start off by defining money. I think this is probably the most important thing to understand. Now, we've had Keynesianism since 1936, and more specifically since 1944, when Bretton Woods first started, and progressively, and particularly after August 1971, the Keynesians and also the monetarists have basically tried to deny that money is gold or silver, physical gold or physical silver, and particularly physical gold, because no central bank, to my knowledge, has reserves of silver. So we're really talking about gold. Now, the fact that gold is money actually goes back to Roman law. It was codified by Justinian in the 6th century. Now, Britain wasn't part of the Roman Empire when that codification took place, because the Romans had already left. But this carried on in common law, which sort of mirrored it. And in 1875, when they merged the Court of Chancery with common law, then we fully adopted the Roman position on money, currency, and credit. So do not listen to anyone who tells you that gold is not money, it's a pet rock, etc., etc. Legally, they are incorrect, and this is a very important point. Now, obviously, gold doesn't circulate. Why? Because we hang on to it. I don't know about you, but if you've got any sovereigns, you hang on to it. You don't spend it. You spend it as a last resort. And this, incidentally, is the position of central banks. They hang on to it. They don't even let their own citizens have access to their gold now. They guard it that jealously. They don't use it to swap things with other central banks, except perhaps on some sort of margin, but on principle they don't. Now, currency is a circulating medium which is used for the buying and selling of goods and services, and that currency comes in two forms. It comes in banknotes, which are issued by the central bank, and it comes in the form of bank credit. All forms of circulating media are credit. Even gold is credit, because what it represents is the storage of your labor before you spend it on something you want to consume, or before you give it to somebody else to make productive use of it, otherwise known as savings. So everything is credit. And what do banks do? Banks are dealers in credit. And to the point that Jamie Dimon was making, they are not here to be responsible to us as depositors, to the Fed, if you like, as an organising medium, or indeed to the regulator, in terms of responding to everything the regulator says. They will obviously not break regulations, but their primary interest is as dealers in credit. Now, if the credit scene turns sour, they will reduce their exposure to credit. That is the whole point of Dimon's warning. And I don't think, in my knowledge, we've ever had a clearer warning that the credit cycle, the bank credit cycle, is about to turn down. Anyway, so since 1971, when the Bretton Woods situation or system was suspended temporarily by Richard Nixon, you can see what's happened to the quantity of the circulating medium, credit, basically. It's gone through the roof. It's actually multiplied 36 times. This is very much in contrast with the situation of gold. Gold as money has expanded over the years, over the centuries. But broadly, apart from time to time, it has expanded at the rate, and I'm talking about all the above ground stocks have expanded about the rate of the human population. So it has had a pretty constant purchasing power. If I move on to this next chart, which I picked from my colleague James Turk, this illustrates the steadiness of gold in terms of purchasing power. This bottom line down here, if I can point to this, see if I can get this to work. Yeah, that line down there is the price of oil in gold grams. Look how remarkably steady it is. In fact, the price of oil has fallen, not risen, fallen by 30% from the $2.57, which it was back in 1950, with gold at $35 to the ounce. It has actually fallen by 30-odd% over that time. Contrast that with what's been happening in these currencies. That's sterling, which of course is an absolute rubbish currency, as you can see. This one here is the dollar, which is slightly less rubbishy. And this one is even less rubbishy, but only statistically because it was the Deutschmark until that point there. So actually, if the ECB had existed before then, that would probably be off the scale. So where is the volatility in the oil price? It's not in the price of oil. It's not in oil itself. It's not in gold. It's in these currencies. And that is the important point, which nobody seems to understand today. In fact, they use the depreciation of currencies. Central banks say 2% per annum, because this is going to stimulate the economy. But 2% on 2% on 2%, compounded up, you see what happens. And it's not just at 2%, right? So, the importance really of this bank credit cycle, I must emphasize. Now, this is a chart which goes back, really covers the whole of the period of the gold standard in the UK from roughly 1817. It actually officially came in 1820 until the First World War. And you can see that there is volatility in the inflation rate. I mean, in some cases it's gone up close to 20%, and it's been followed by a downturn. Now this is the result of the expansion and contraction of bank credit. Remember I said that roughly 9/10 of the circulating media in existence is bank credit. It is not banknotes. It is not gold. It is bank credit. So when bankers think things are looking up, they obviously expand their balance sheets. I need to tell you how that happens. Double entry bookkeeping is a wonderful thing. You walk into a bank and you say, I've got this mining project, and you convince the banker to make some money available to you. You then sign the documents. And as you leave the building, the banker shakes your hands and he says, the money is now in your account, so you can draw it down. What he means is that on the asset side of his balance sheet, he has your loan. Your loan is an asset to the bank. But that's got to be balanced on the other side with a liability. So matching that loan, quite simply, is a deposit. Whether you call it a checking account or a current account or a deposit account, immaterial. But you have got exactly that money to draw on the deposit side, and that is the liability. And it must balance the whole way through. The bank hasn't gone anywhere to get this money, it's just created it out of thin air. It hasn't had to wait for depositors to come in and deposit money so that it can lend it on. That's not how it works. It's very important to understand this, to understand why it is you get these contractions of bank credit. What it means is that the cohort of bankers go through periods of exuberance and fear. Greed and fear, greed and fear. And it's a cycle which you can see from the peaks there, runs roughly every 10 years. Once every 10 years, I mean give or take a year or two. And as a matter of interest, of course, the last time we had this cycle in current times was the Lehman crisis, which was August, if I remember correctly, August or September 2008, and here we are, 13 years later. This is getting long in the tooth, this really is. So that's the importance of bank credit. Now you can see what's happened to the purchasing power of these fiat currencies. I mean, I've already shown you the stability of the price of oil measured in gold grams. It is also true of virtually every other commodity. And in fact, I was looking the other day at something that Diocletian did. He wrote an edict in stone of prices when the denarius collapsed. We're looking, 230 AD, something like that. I mean, long time ago. And he wrote this edict, and very conveniently, he put a maximum price of gold and a maximum price of silver in. And that's interesting because the gold-silver ratio in those times was 12, according to Diocletian. But the other thing that was interesting is that if you look at basic items like food, eggs, chickens, clothing, oxen, and carts and things like that, these were all fixed, and if you look at the similar prices of similar items today, it's actually not all that much different. So in fact what's happened is that the purchasing power of gold for millennia has just moved sideways. It's been stable, it is stable. You will not have lost value holding on to your gold. But fiat currencies, this was from Nixon's ending of the Bretton Woods. Look what's happened to them. Even the mighty yen has lost 95% of its purchasing power. And if you look down at sterling, I mean, we've only got 1% left. I think the dollar is 2% left, and the euro is somewhere in between. So you can see that the problem is fiat currencies, not money. Real money is gold. Now, I was invited by the IMF to have a debate with a guy called Sultan Pozar, who works for Credit Suisse as one of their short-term money specialists, because he came up with this description that we are coming out of Bretton Woods 2, going into Bretton Woods 3. Now, what does he mean? I took up this meme, as it were, and the IMF noticed it and thought, well, perhaps Macleod could explain this in language which hopefully is a little more clear than the language that Sultan Pozar uses. So anyway, here it goes. What he was saying is that Bretton Woods 1 it ended in 1971, and no need to go on beyond that. Now, since then, what has happened is the creation of the petrodollar and financialization of the global economy. Now, what do we mean by that? Well, after the petrodollar was created, and then after we had that rather nasty inflationary period in the 1970s, you may recall that Paul Volcker jacked up interest rates at the end of the 1980s, sorry, the end of the 1970s, so they were around about 20%. Now, basically what he was saying to people who were trying to flee the currency, look, you leave the currency, you're going to lose 20% interest. This was a very important point. Now, going on from there, what happened was that there was obviously some bright guy worked out that the way in which, after that, to keep the purchasing power of currencies under control rather than having them diminish it, was to create a situation where demand for that money, demand for the currency, would accelerate. And this is behind the financialization of the global economy. Now, where it has left us is it has left us with banks holding the highest level of financial assets as collateral against its loans that we have seen in history. Usually we take, say, a lien on a lease for a factory or whatever. All that's gone off to China or somewhere anyway. So it is entirely financialized. Now, what Zoltan was saying is that we're now coming out of that, and we're now going into Bretton Woods 3, which is the commoditization of currencies. And the sanctions against Russia have given Russia the opportunity to lead the way on that commoditization. I'm not going to go into that terrible, enormous depth, because what we're really interested is how is this going to affect financing for mines and mining ventures. Well, in my mind, the good news in all this is that after a period of enormous disruption, what we are likely to see is the political class and central bankers finally rejecting macroeconomics and understanding what we have always known, and that is that true money is gold and silver, physical gold, physical silver. And they must back their currencies with physical gold and or silver. I mean, it will be obviously physical gold. What the Russians are doing is they're using a basket. I mean, they're using everything they export, if you like. You have to buy rubles in order to take delivery of oil and so on. The fact of the matter is, there will come a point where the politicians' salaries are going to disappear down to zero unless they do something about it. And at that stage, I think that the backing for currencies will become commoditized in the same way as Russia is leading the way now. But what they should do, they will probably not get there initially, is to use gold, which is money legally, and do it that way. So my message to those looking at in the mining finance industry, both as supplicants and providers, is that things could cut up very rough. We are about to have a major credit crisis. Look what's happening to the euro. If you think about what's happening to bond yields, just imagine how that affects the ECB's balance sheet. They're in negative equity. The Fed said the other day that unrealized losses on their bond portfolio are 330 billion against equity of 50 billion. So they're already in negative equity. The Bank of England has done a fairly smart deal. I won't go into that. Japanese yen, exactly the same thing. Now, they've drawn a line in the sand. They're saying we're not going to let the yield on the 10-year JGB go over 0.25%. And so what they're doing is they're trashing the currency by not accepting that interest rates should be considerably higher. So, and that's what's happening to the Treasury yield. That is going to continue, incidentally, and that does not yet reflect the situation which is obviously scaring the pants off Jamie Dimon. And lastly, because I'm sorry I've run out of time a little bit, Robert, but lastly, I come back to this. The big message that I have for everyone here is that if you price things in gold, you don't get the volatility that we have become so accustomed to in paper currencies. That is where the volatility lies. Thank you.